Welcome back. So far in the Fund Accounting Basics series, we have understood what a fund is, who is involved, how money moves through a fund, and what fund accounting is responsible for. Now, we are ready to gently start looking at recording. But don't worry, we are not jumping into complicated accounting jargon. In this class, we are simply asking, when something happens in a fund, what changes? Let's quickly recap where we are. We first learned what a fund is. Then, we learned who is involved, like the LPs, the GP, the administrator, the bank, and the auditor. After that, we followed how money flows through a fund. Then we understood what fund accounting tracks in practice. Today, we are taking the next step. We will look at simple booking examples. Again, the goal is not to memorize journal entries. The goal is to understand the logic behind recording. Before recording anything, the fund accountant asks a very simple question. What changed? For every transaction, we can ask, what did the fund receive? What did the fund give up? What increased? And what decreased? If you can answer these questions, the accounting becomes much less scary. Fund accounting begins by identifying the change. Let's start with the first example. An investor sends $200,000 after a capital call. So what changed? First, the fund received cash. That means fund cash increased by $200,000. Second, the investor's capital increased because this investor has now contributed money into the fund. So in plain English, the fund received cash and the investor's position increased. Now, let's look one step deeper. This one transaction affects two records. First, it affects the total fund. The fund now has an additional $200,000 of cash. Second, it affects the individual investor. That investor's capital account now shows an additional $200,000 contribution. This is why fund accounting is different from normal company accounting. We are not only tracking the fund as a whole, we are also tracking each investor's position inside the fund. Now let's move to the second example. The general partner decides to purchase an investment for $150,000. So again, we ask, what changed? The fund cash decreased by $150,000. But the fund now owns an investment worth $150,000. So cash did not simply disappear, it changed form. Before, the fund held cash. After the transaction, the fund holds an investment. This is an important idea. Buying an investment is not the same as paying an expense. The fund has exchanged one asset for another asset. Let's look at the before and after. Before the investment, the fund had $200,000 in cash and zero investments. After buying the investment, the fund has $50,000 in cash and $150,000 in investments. So the total assets are still $200,000. The form of the assets changed, but the total stayed the same. This is a very useful way to think about investment purchases. The fund did not lose value just because it bought an investment. It simply changed cash into another asset. Now let's look at the third example. The fund pays a $5,000 audit fee. Again, we ask, what changed? The fund cash decreased by $5,000, and the fund expense increased by $5,000. This is different from buying an investment. When the fund buys an investment, it receives an asset that may create future value. But when the fund pays an audit fee, it is paying for a service. That service has been used. So paying an expense reduces the fund's value. Now let's put the three examples together. The investor contributes $200,000. That is mainly balance sheet activity, because cash and investor capital increase. Then the fund purchases an investment for $150,000. That is also balance sheet activity, because cash decreases and investments increase. Then the fund pays a $5,000 audit fee. That is income statement activity, because an expense is recorded. After these transactions, the fund has $45,000 of cash remaining. It also owns a $150,000 investment, so fund accounting records every stage of the story. This final slide is a simple cheat sheet. It shows that funds can record many different types of activities. Investor money coming in, investment purchases, expenses, dividend income, interest income, changes in investment value, investment sales, distributions to investors, and even accrued expenses that have not been paid yet. We do not need to learn every booking today. The goal is simply to understand that every fund activity creates an accounting effect. Something happens, something changes, and fund accounting records that change. That is the key takeaway from this class.